Welcome back to Kitco News. I'm Jeremy Szafron. The U.S. labor market just buckled. July payrolls rose by 73,000, but the real damage is in the revisions. Nearly a quarter million jobs wiped off the books from May and June. Now, the three-month average now sits at just 35,000. That's the weakest run since the pandemic. Meanwhile, unemployment is rising, participation is falling, and the market is now pricing in a September rate cut with near certainty. Meanwhile, gold is catching a bid here after this economic data release, testing around $33.50 an ounce. And behind the price action, the latest gold demands trend report from the World Gold Council reveals a very interesting shift. ETF flows are surging. Jewelry demand is collapsing. U.S. retail buying is kind of dried up here. And meanwhile, central banks are quietly stockpiling gold off the books. Joining me now is the man behind the data, Joseph Cavatoni, of course, Chief Market Strategist at the World Gold Council, joining me now. Good to see you, Joe. Thanks for making the time.
Great to be back, Jeremy. Thanks for having me.
Okay, interesting report. Lots kind of out there. Let's start with that top line figure. Total gold demand in Q2 came in at 1,249 tons, right? That's only 3% year over year increase. But in dollar terms, I mean, demand actually hit a record, $132 billion. So what's the disconnect? Modest volume, historic value. What does that tell you about this market?
So there's a lot that it tells us. The first thing is that number is very, very substantial and actually very meaningful. So number one, don't lose sight of the fact that 132 billion of new demand is significant and actually meaningful. Second, the numbers, while modest in terms of their growth, they're growing and actually growing in areas where we are expecting to see an increased level of activity and growth, particularly as you've highlighted. The numbers in ETFs are telling us that, but investment overall. So I think it's giving us certainty that the growth potential still stands for gold, that the case for gold still remains strong amongst the investment community. And also all of this happening, as you've highlighted, with one area that we would have expected to be down, jewelry, being down. So I think it's a positive number. It's also going into the summer months when things kind of slow a little bit. Yeah. And I think it's actually very encouraging for what we're seeing.
You know, is this the case of, price doing all the work, or is there real structural buying beneath the surface here?
I think that's a great question, and I think it's structural. So what I think we're hearing and seeing more and more from investors is waiting and seeing for what exactly is going to develop on the monetary side. I think the news that you've just highlighted in terms of the revision of employment numbers is something that's really critical, because that is a key catalyst for gold, when the Fed will move on rates, when the dollar will show signs of weakness. And it's actually looking like, as expected, these revisions are starting to show more impact from trade-related discussions, the potential for tariffs, and actually these numbers are starting to show weakness. So I was expecting a little bit more from the Fed this past week, but it came out with no cut. Now we're getting all but certainty, and maybe even the administration, echoing what they've been saying, which is you need to move on rates. And actually, that might start to be a lot more commonplace in terms of the rhetoric that we're having right now. And investors are standing there holding their gold, increasing their overall level of exposure to gold, and looking to continue to put more to work in gold.
Yeah. I mean, it's kind of fascinating when you look at the inflows. I mean, they're not speculative. I mean, it almost feels like, what did they hit? 170 tons last quarter, strongest half since 2020. But those flows were concentrated in just a few weeks. So I'm wondering, are investors committing long-term capital here, or are they just trading policy risk?
So the couple of key points to highlight there, these are the ETF flows, which still isn't the lion's share of where investment is basically being held. The investment being held in OTC flows, which is actually continuing to be strong and has been for the last 5 to 6 quarters. But again, what it does tell us when we see the flows in ETFs, that the investment dollars are quick to move, and they can move and be meaningful. I think Europe is the one market that I continue to watch, because I think what we compete with in gold is an appetite for ongoing risk assets. And right now, I think Europe's still behind where you're seeing North American flows, which have been record setting, as well as Asian flows in ETFs. So I'm keeping a close watch on what's going to develop in Europe and how risk assets are going to continue to play a role there, because I think that that's the market that we could see yet again, another one of these tipping points where flows come quickly to market. And again, it's sticky. Remember, it's sticky. The flows are not seeing outflows. That's what's key right now.
Right. And, you brought up the OTC, the over-the-counter, and those inventory flows. The report showed another 170 tons going to OTC, almost the same as the ETF demand. So what is the bucket made out of? Is it hedge funds, sovereigns, high net worth, private clients?
It's anywhere where you're having investment dollars being put to work on the physical form of gold that basically doesn't have a disclosure mechanism. So that would include private banks, that would include wealth offices, that would include those that are buying in physical form, whether it's global or here home at the US or whatever it might be. But it also can include some institutional stock that might just be held and not disclosed by those financial institutions that hold it. But at the end of it, it's actually consumption of gold, and it's consumption of gold in that format that is consistent with investment. So we look at that and we get very comforted by the fact that it's finding a home, and it's actually finding a home with those that are actually holding on to it.
I got to ask you on the ETF flow, just going back to that before we move on. I mean, are we seeing a shift in geographic participation? Is this still a US-led trade, or are other regions now dominating gold ETF flows?
I just mentioned Asia. I think it's a key market to watch in particular,
Right.
the key region to watch. I think in particular, watch China. And again, appetite for risk versus protective assets to offset risk. So China's had record flows. It continues to be a market that dominates. As we move beyond the second quarter report that we have and into July, we're showing some signs of the investor maybe looking to take a little more risk in China. So that's a key market to keep a close watch on. I think other markets around the globe that are teed up to be material, Japan is a market that has very good conditions for investors to look to diversify away from yen and bonds and into gold market activities. There's an ETF market that's very robust there. But again, back on the home front in the US, this is a market that's actually looking at more like 2 to 5% allocations. That's what asset managers are talking about. It's not this 1.25% that we've heard in the past where we've seen the numbers. We're talking more like 5% allocations. And again, what's important as well is that's coming along with a message that says it's sticky, don't sell. If anything, add to your allocation.
Interesting. We got to ask you about the bar and coin demand. I mean, the divergence is stark. You just mentioned China. Demand jumped 44% to 115 tons. And in the U.S., it happened to collapse by 53%, down to 8.8 tons, the lowest level in 5 years. What happened to the U.S.?
Well, I think that the market in the U.S. is unique and actually has a really interesting characteristic in terms of its buying behavior. We see that the conditions in the U.S. for well-disclosed and high-volume activities in the bar and coin market, usually during a market condition where the administration might be questioned, a Democratic administration where there might be more concern amongst that buying community that the cost of government, the cost of spending, the conditions of government might be leaning more towards having something a little less in the mainstream investment landscape, so bringing it into the bar and coin environment. So it's not a big surprise for us to see that the conditions for bar and coin continue to be less interesting for those in the US. But again, the institutionalized and the commercialized forms of retail buying have been picking it up in the ETF market. But in China, again, across the board, ETFs and bar and coin showing consistent flows there. So you're actually seeing a condition of accumulation.
I almost wonder if it's just price, right? I mean, is it simply just about these high prices kind of choking off access? Because it doesn't seem like the U.S. Retail interest is exhausted at this point in physical gold.
It's a good question. I think that maybe that could be playing into the psyche of those that are actually in the bar coin market. But again, what I'd say is probably more likely is probably less of a concern around the conditions that would normally bring those investors to the market. So, but high prices do impact what does take place in retail consumption. And that's actually to your point earlier around the jewelry market, which is what we're seeing across the globe, a significant decline.
When we talk about, official sector buying, the report showed 166 tons in net central bank demand, more than half of that. I think 90 tons came from these unreported sources. So who's buying under the radar? I mean, I remember in Boca Raton, you and I talked a little bit about this. And obviously X is always talking about China accumulating some of the sovereigns. But is this now a dominant channel for, official gold accumulation?
I think it most certainly is. And again, our number at 160 some odd tons this quarter is down relative to what we've been seeing over the last few quarters. But again, what I'd highlight for your listeners is that these are numbers that are at or near record-setting levels. So when we see a decline from the 240 we saw in first quarter to 160 roughly in the second quarter, we see this still to be super strong. And actually, our survey report tells us that these central banks are continuing to think about gold as a key reserve asset. So the channel is very strong. It might be a little more price sensitive than maybe we were expecting. And we expect it to be material, maybe not record setting in terms of the flows over 1,000 tons. But again, it will be a continued theme of ongoing buying from central banks as they diversify away from a weakening dollar and weakening dollar assets.
Is this underreported buying kind of happening at a scale that it could distort the official narrative on reserve flows? I mean, how much gold's really moving that we don't see in the public data?
So we work with a couple of organizations, and in particular, we spend a lot of time working with metals folks. We have a very robust process of validating their data. So we stand behind the numbers and we feel comfortable and confident on them. But when you start getting into sovereigns buying and entities that are linked and related to the different activities that go along with central bank reserves, ultimately, you have to be very careful and cautious. There might be a time lag. There might be an entity that's being used for a particular purpose or reason on the shorter term. And we do our best to actually make sure that the numbers are complete and clear, but also very robust before we publish them. So we are comfortable with the mechanism and the fact that the numbers stay off the grid. You know, we have had examples in the past where several months after the accumulation has taken place, a particular country might come out and make the declaration under the IMF framework. So we feel good about it. And I'd say that the numbers are as robust as you're going to see from anybody in the community.
Been wild watching kind of that little bit of demand falling over in the global jewelry demand that you were talking about. I mean, it's almost back to kind of pandemic era lows. China was down 20%, India down 17%. That's a big hit for the base of, that little gold market. At what point does sustained high pricing really kind of permanently impair this segment, do you think?
What's really interesting about the space is it is a lot more price sensitive than the other categories that we're talking about, particularly investment. But when you think about what needs to take place in the jewelry market, it takes time. Two things that need to develop. The recycling market needs to come online, and some of that gold that basically is maybe less interested in being held on to needs to make its way into recycling. That we haven't seen as much of it as of yet, which tells us that there might be more price upside being signaled by that community. But the second thing that needs to happen is the jewelry market and the jewelry fabrication side of things needs to come up with better design, more access points that can be dealt with at a lower price point. And I think that takes more time to develop. So it is starting to take place. We have some examples that we've been hearing of in China where there are growth areas in the jewelry market, small right now, but they're rolling out smaller consumable designs that can actually be accumulated at lower price points. So price up, consumption of jewelry has to be designed in a way that they can get it through a lower price point.
Yeah, it's almost, I mean, I looked at the data and Iran was the one outlier there. Jewelry demand grew. I wonder if it's real consumer strength or if it was people picking up during that recent war activity. I mean, do people kind of front run these types of occasions with going and buying gold and jewelry, those types of things?
There's a long history of the affinity for gold being linked to also the portability of gold. So if an individual is looking at what can I put on my wrist, around my neck to get out of a country, I think ultimately gold can play a role like that in a market like Iran. So I think that there is a sense of saving, there is a sense of portability, there is a sense of security with it. And I think ultimately that could be playing into what's driving a little bit of the demand in a market like Iran, plus the types of gold available. You're not looking at a market that's got a robust ecosystem of exchange-traded products that are available for people to use in their brokerage accounts.
That makes sense. On the supply side, I mean, mine production hit a Q2 record, 909 tons, but average all-in sustaining costs kind of rose over about $1,530 per ounce. You were just in that conference I talked about over at Rick Rule. You're talking to a lot of the miners. Is this something that you're hearing more of, that these margins are getting a little bit squeezed here at these prices? The costs are going up higher?
I think they're moving as fast as they possibly can to get production online. I think they're doing a good job of that. What is interesting, though, is that some of the factors that really do play into the costs are continuing to plague them. I think energy costs, the cost of labor, All of these factors are still weighing in on them. So I think what we need to see are the production levels continuing to grow, because at this stage, the factors that are around it are going to continue to be somewhat volatile and somewhat impactful on their ability to produce at higher levels. Again, a good quarter for mining, and actually growing at a pace that's still under the level of pace growth with respect to the demand side of what we've got in the equation.
Despite these high prices too, I mean, recycling rose just
Yep.
4%. It's kind of muted, no? I mean, in India, pledged gold jewelry used as collateral for loans is kind of spiking, which is very interesting. What happens if financial stress triggers liquidation? Could we see a sudden supply surge?
This is back to the point I made a moment ago about jewelry. It's just really giving us a signal that maybe the fabricators, maybe the investment in jewelry is still seeing more upside before they actually move the monies into the recycling cycle. Or for that matter, maybe a similar sentiment that you have with the investment community, where it's like, I'm going to hold on even though I know prices are maybe flatlining at this point. But it is a number that we would have expected to be a bit higher, considering the rapid growth over 25, 26, 27% year to date. We would have expected the number to be higher, in particular in markets like India and China. Just hasn't gotten there yet, but it is something that is moving up. So let's keep a close watch on it, because it might signal that community's level of telling us where they think the prices are tipping up and hitting their peak.
That makes sense. And on China, I mean, regulators there, we talked a little bit about it. They've now allowed insurers to hold physical gold. How significant is this move? But also, are we kind of looking at the emergence of maybe a new institutional demand base if this happens?
Yeah, it's a great development in that market. I think it speaks volumes about the fact that the institutions are understanding gold. I think the institutions are understanding portfolio allocation, which we know they have the ability to do, and they have done for years, and opening up this channel under a pilot program. So let's just be careful to make sure that we don't get too overly excited over the fact that it's still being piloted. But at this stage, that pilot program in works tells us that the government, the regulators, the institutional bodies overseeing the insurance community, and insurers are understanding portfolio diversification and the benefits of gold as an asset allocation.
I got to ask you, I mean, we always ask you about price, and I know you're not going to give me a price, but I mean, heading into the second half of the year, jewelry is kind of weak. Retail is a little bit fractured. Central bank buying is increasingly kind of opaque. Can gold hold above $3,300 based on these foundations, or are we kind of in a holding pattern until that next Fed move?
I think the conditions of the economic outlook for not only the U.S., but other major markets around the globe are continuing to be very supportive of the gold price. I think that you're seeing some firms making revisions to the downside. Even those revisions on the downside are still going to have us in very positive territory if those conditions play out. But personally, and I think from the perspective of our organization, we see those economic conditions continuing to be quite supportive of those that are calling for price appreciation between now and the end of the year, but also into 2026. I think people just need to understand that there's patience that needs to be played out with the gold market, and you're going to see some bit of price headwinds when it comes to certain noise and news that are going to hit the market. But what we've just seen this week with a Fed hold, and now some revisions of numbers, and now increased pressures and economic conditions starting to show their signs, we should be expecting to see an environment that's going to be favorable for gold going forward.
Yeah, makes sense. It's looking kind of ugly, to be honest. And I mean, the market's now obviously pricing in kind of an imminent cut in September. Some saying two. I mean, if we do get 50 basis point cut in September, what's your call? Does that push gold to 3,500?
Certainly. It will push gold upwards, and then basically it will be a catalyst that we've been talking to, which we've been looking for. We're looking for another big systemic kind of like a big conditional, I should say, a big conditional move for gold to kind of get its next wave up beyond this very strong run we've had so far this year. And that will likely be the move in rates and the actual weakness of the dollar and those conditions for questions on what and how to handle your risk assets in your portfolio.
Yeah, Joe, here's the final one before I let you go and enjoy your weekend. What's the most important trend in this report that investors aren't really paying enough attention to? What data point do you think markets are missing here, or that could become the next driver? We just talked about these revisions, losing a 250,000 jobs. But what are your thoughts?
So I think the key thing to keep a close watch on for the next 90 days to call it 6 months, would be the appetite for risk assets from investors, their willingness to take risk and sustain kind of shocks to the system, because that's what we're continuing to see. It's not just a U.S. thing, though. I'd actually keep all eyes on China as well, because those two markets will give us a big, significant outlook for risk assets and actually the appetite for continued growth of the gold market in terms of the investor universe.
Yeah, happy Friday. A fast-moving market. Joe Cavatoni joining us now. You can find that report, of course, at the World Gold Council's website. Thanks for this, Joe. Always a pleasure.
Thanks for having me.
Appreciate it. And to our audience, this isn't the same gold market. The players are changing and the flows are moving in the dark. The old demand drivers aren't what they used to be. We're going to stay on it right here at Kitco News. I'm Jeremy Szafron. We'll see you next time.